G'day folks, in today's video we'll go through some key commodities with some fundamentals, then cover the same looking at technical analysis and covering back tests on what each instrument could have returned using some of the strategies we've covered in past videos. To get a better understanding of the concepts, I'll go through here, reference the +1 videos which explain some of the strategies outlined today. Links in the description below, and if you're new to the channel or are new at investing, my daily videos aim to walk you through the discipline of monitoring the charts and preparing you for independent trading. So even if you don't intend to trade any of the instruments in this video, by following the methods outlined, you can better develop your own style for successful investing. Learning to trade in the market is like learning a new language. You're not going to learn by watching a couple of 10-minute videos. You need to follow a steady, frequent guidance to set you up with a better foundation. So let's begin. In summary, commodities are showing a split picture. Precious metals remain broadly bullish, supported by strong central bank and investor flows in gold, structural industrial demand for silver, and multi-year deficits in platinum. Base metals are mixed, with copper underpinned by supply disruptions, but capped by fragile Chinese growth, while iron ore stabilizes as seasonal steel demand offsets property sector weakness. Energy is turning softer, with crude oil facing a clear surplus in 2026 and natural gas pressured by record storage and resilient production, though both remain vulnerable to geopolitical or weather shocks. Overall, structural deficits for silver and platinum contrast with cyclical oversupply for oil and gas, leaving macro drivers, US dollar strength, Fed policy, and China's trajectory at the main swing factors across the complex. I won't go through this chart, but it shows the data sources used in the previous table. So let's get stuck into the charts. Again, to try and follow the key points I make here, even though you're not trading these particular instruments, try and follow the same methodology to better understand the concepts. So we look at the long-term trends first. So even if you're trading on the 1 hour, we still look at the higher time frame. So to get a better understanding of the overall trend. And on the weekly here, you can see the price had a massive drop in the last week, or a few weeks ago now, below those moving averages on the price chart, but also below the moving averages of the CCI. And again, if you're new to the channel, these moving averages are in the description below to learn how to draw those on your own charts. So at the moment, bearish momentum on the weekly. It was bearish as well. We marked it here with a blue arrow. It was bearish here in that particular day. This is the daily chart, when the CCI and the price dropped below that moving average range. Now, you would have gone short during that period, and you would have closed out your short positions once that CCI crossed into that moving average range. You'll notice it was down near the bottom there on that candle there. And that gives you an early warning exit following the CCI 150 as opposed to following the moving average on the price in isolation. And here on the daily, on the 1 hour time frame, what we're looking for is any divergence. Normally what you expect to see is the price and the CCI moving in tangent in terms of getting new highs on both the price and the CCI, but also new lows in conjunction there. So what we're looking for is any divergence. Like if you go back here, for example, we saw lower highs versus higher highs in the price, hit that resistance, and then the price dropped from there. And that's what we look at as a bearish divergence, and that gives you an early warning. So if you're going long during that period, you would have started getting ready to exit the trade once you started seeing that bearish divergence. Now, in terms of a back test, what I've got here is on the daily, on the left, and on the right here, I've got the 1 hour time frame. So you would have gone short during that period, as I said, once it broke below the price and the moving averages on the CCI, and that would have been this period here, back here on the 1 hour time frame. Now again, as I said, at the very latest you would have got out when it hit that moving average range on the CCI on the daily, but also following the price movement and the CCI movement on the 1 hour, you would have got out at the very latest on that point there when the CCI hit that moving average range. So you would have got out near the bottom there, and at the moment you would not be trading long or short, because what we're waiting for is we want to see both the price and the CCI moving in alignment. The CCI is a very narrow range there, and so is the price in that moving average. So it's pretty much undecided, and that's why we're looking at a sideways move, calling it a neutral positioning. So if the price broke above there, and what I'd like to see is the price with the moving averages starting bending upwards like they did back here, along with the CCI, that's where you'd start taking a long position. Or alternatively, you want to see the price and the CCI break to the downside before taking further short positions. So at the moment, had you got it into the short position there and got out of that trade there, you would have got out with a profit of about $3,500 trading that small range with that dip in that period. And you would have avoided going short again from this period, even though I've got the program running short. You would have avoided that drawdown had you got out of the trade because of that bullish movement on the 1 hour time period. Next, looking at iron ore, first look at the weekly chart. So again, the price is well above the moving average range, and so is the CCI. Now the CCI is pulling back towards that moving average. So if you're trading on the daily, we always trade in the direction of the higher time frame. So in the weekly, if we're trading on the daily, we look at the weekly. So you can see there it's about to break into that moving average range, very likely. The daily is pretty much moving sideways, confirming that sideways move. So just be careful about going long too strongly at the moment. But at the moment, bullish move on the weekly. On the daily, likewise, we've got this sideways move. Now the price has been, and the CCI have been fluctuating above and below those moving averages. And I've got a down arrow there showing where you would have gone short more recently. And at the moment, you'd be holding off going any particular direction. You want to wait for a decisive move. So let me just draw that sideways arrow at the moment. So wait for that to either break above on the CCI, the price is already above that, or alternatively, both the price and the CCI break below to take short position. So at the moment, neutral positioning on the daily, which means you don't trade at the moment on the 1 hour time frame. Now what we're looking at here as well is looking for any divergence. So we always work backwards. You can see there higher lows on the CCI and the price, and higher highs on the CCI and the price. So there's no divergence. The last divergence we had was back here. We had a very strong downward pressure on the CCI versus higher highs on the price. That finally broke down below our moving averages, and you would have closed out any long positions there. And I'll show you the back test in a second. But that was the last divergence we had. Back here we had a bullish divergence, almost like a triple bottom on the price versus higher lows on the CCI, and that was a confirmation to break higher above those moving averages on the 1 hour time period. But again, we always go in the direction of the daily. Now looking at the back test, first we look at the long positions. So I've drawn a up arrow here. You would have gone long at that point there. The price broke above the moving average range, and so did the CCI, was already above it, and you would have taken long positions there, and that's what I've got here on the 1 hour time period. You can see there, had you let it run, that would have been a nice little profitable gain. And again, following that bearish divergence, that's what I use the divergence for, you would have started getting ready to exit the trade when it started breaking below the moving average range. Now notice here, the price moving averages, that's why I like zooming out sometimes, the price moving averages kept flowing higher, even though the CCI was dropping off. You can still stay in a trade, watch it closely, and as soon as you start seeing that price break below and the moving averages bend down, you could have got out of that long positioning there, and that would have returned about $45. Not a huge return on iron ore, but again, better than nothing, better than a kick in the teeth. Now during that period as well, avoid going long or short until that period there. You could have got in again there at the long entry at this point, and that would have given you a few little gains there. And again, watching for that CCI to break into that moving average range, and you would have got out there with one little trade there possibly. And then more recently, wait for the price and the CCI to break below, and you would have taken short trades. And the short trade is here, one little trade to take, and that would have returned about $3 depending on the instrument or the contract you would have traded going short. Again, very minimal, but again, following the discipline. Next, we look at spot silver. Now on spot silver on the weekly, the price is well above the moving average, making potentially new highs. It's coming towards that resistance area. But notice the CCI has already broken into that moving average range, but it looks like it's about to break higher again. So again, once it breaks out of that moving average range on the CCI, you can start taking long trades again on the daily. I've marked here some arrows going up and down where you would have gone long and short on more recently, and that was a bit of a roller coaster event during those periods on the daily. And more recently, again, notice here on the daily we had a bearish divergence, and that actually broke down, hit our 23-38% target range. Let me just blow that up for a moment. And the way we measure that bearish divergence target range, we take a Fibonacci high from that point there when that divergence finished, and we take it back to that significant low, which would have been there at that point there, and that was that 23-38% range, broke down and hit our target range. And I don't trade these divergences. I use it as an exit point. If I'm going long, I use it as an exit point to get out of trades once I start seeing a bearish divergence. Or alternatively, if I'm going short, I look out for any bullish divergence to exit a trade. So again, I don't trade them because you don't know how far it's going to go to be able to take profits necessarily. You can trade them, but I don't trade them. So again, on the daily more recently, you can see that you would have taken a long position at that point. But again, just notice that we need to see higher breaks above that resistance to be able to go long. At the moment, you might be in a break-even point on that particular trade. So just be cautious. I'll show you the back test in a second. Again, looking at the 1 hour time period, looking for any divergence. And look, working backwards, you can see there those highs are in movement with the price on the CCI and the price, higher lows as well. And back there we had lower lows on the CCI as well as the price, so no divergence there. The last divergence we had was back here. We had lower highs on the CCI versus higher highs on the price, and that pulled back more than 23% of our Fibonacci range. If we drew a Fibonacci from that range there before that divergence started, you can see there it broke very quickly through that 23-38% range, and it went close to that 100% retrace. It bounced off that out of that 61% and then finally broke below that 100%. So again, we can't really tell often how far these pullbacks happen with these divergence. That's why I don't trade them. They're not as reliable as the trend following method. Going to the back test, first we look at the back test here, beginning on around about the 30th of July, during this period on the 1 hour period, when the price and the CCI are below the moving averages. You would have taken short entries. Now again, notice once it broke above here, above the moving average or the price chart, you would have closed out your position there at that point, and that would have returned approximately $2,320, trading the spot silver instrument or contracts. You would have avoided going short during this period. Remember, we're only going short because the price and the CCI are still below the moving average on the daily, so you would have avoided going long and avoided going short until such time at that point there when it broke above the price and the CCI moving averages. It hasn't actually broken above the CCI yet. You probably could have got in early there. And let's go to the long positioning. You can see there you still could have done it, but again, it would have been a bit risky. It was about to break higher on the daily, but you would have gained a few points there and then closed it out at that point there. So you would have made at that point $2,130 closing it out once it broke below the moving averages on the price there. Notice there as well, you're probably seeing a bearish divergence versus almost a double top on the price chart. Again, avoid going short until we started seeing both the price and the CCI break below there. I haven't marked it on the 1 hour here. You probably could have taken a short position there and then taking another long position. Probably would have avoided taking that long position because that's still bearish on the daily. And the latest one would have been at this point here going long again there when the price on the daily was above the moving average, and so was the CCI. On this one, there's been no contract open according to the strategy we're using, and so you're probably just standing away from the trade at the moment. The CCI is breaking into that moving average range, so avoid going long or short on the hourly because you want to wait for that to break higher outside of that moving average range. So US crude on the weekly first off, that's still bearish, both price and CCI below the moving averages. Now getting a bit of a pullback so far this week towards those moving averages on the CCI and the price, but still predominantly bearish at the moment. On the daily, again, at the moment, neutral positioning. The price is broken into that moving average range and the CCI is broken higher. So that's currently bullish on the CCI, but we want to wait for that moving average range to start bending up like it did back here to take long trades on the 1 hour time period. But I've marked here with the arrow when the price and the CCI break below the moving averages, and that's where we start our back test. Before we go to the back test, first we look at for any divergence. Now we did have a bullish divergence back here. You can see there we had a target range. Now that kept rising on the CCI and so did the price, but then it fell off quite suddenly. And since then, the CCI has actually dropped to a lower low, and it was also a lower low on the price, which means the divergence was invalidated. So that's why you've got to be very careful. I don't trade these. I look at it potentially if I was going short during this period, then I'd be trying to follow any movement to the upside on the price and the CCI for a confirmation of a divergence. But at this point, it invalidated the divergence, so we're going to delete that trend line at that point. Now since then, the price lows are higher and so are the CCI lows, so no divergence. But notice over here we've got a bearish move on the CCI versus a bullish move on the price, higher highs, and that's giving us a bearish divergence. Now if that pulled back as a minimum, we could take it back to that point there, but it's already broken through the 23-38% range. So let's take it back to this significant low. I'll draw a target range there just for future reference, and that'll be somewhere in that 23-38% range. We can expect the price to come back. It could just touch it, or it could fall right through, so we don't know yet. At the moment, the CCI is still dropping and falling further. So I'll get rid of it. So that's our target range on the hourly. So let's look at the back test. And what I've got here showing you the back test going short when the price broke below the moving average, and so did the CCI. That's where it's indicated here on the hourly. You would have taken short positions, and up until now, you would have closed out at each time the average started bending up on the price chart and taking further short positions once the CCI and the price were breaking below again. You can see there, that's where you would have had the last trade, and that would have generated just short of $7,000 so far. And that could possibly open up a new trade once that breaks below the price and the CCI. But at the moment, there's no trades happening. And as I said, you wait for that on the daily to confirm that's moving sideways. So wait for that price and the CCI to break below on the daily to take any short trades, or alternatively wait for the price to break above that moving average range to take a long trade. So at the moment, stand clear, don't trade long or short for crude oil. So looking at platinum, spot platinum on the weekly first off, the price is very bullish above that moving average range. But notice the CCI is broken down into that moving average range, giving us a neutral positioning. So avoid going long or short until we see a more decisive move on the price and the CCI in alignment. Now I've also identified this fair value gap down here. These pretty much are unfilled orders, so we might see the price retrace back into that area. But again, I don't trade the fair value gap. I just mark it as a potential area of a support if the price does come down towards those moving averages. On the daily, you can see we had a bearish divergence, an early bearish divergence, lower highs versus higher highs in the price. The CCI kept falling and the price kept rising until such time where I've marked it with an arrow there. It finally broke through the price in alignment with the CCI. So ideally, you want to be very cautious. If you're very conservative in terms of your trading and avoid too many risks, you would have avoided going long during that period. Or if you were following it, you could have then followed it and tracked it against the price moving averages. And when you started seeing the price then break below there, even though the CCI was declining, you could have held on to that. But again, that would have been a very potential risky move, because that could have been a sharp fall. Like you notice when it pulled back there, had a very strong bearish candle during that fall. So at the moment, you'd be going short according to the daily trend. Again, notice the CCI is moving towards that moving average range, giving us a possible neutral positioning, but still short overall. On the hourly, again, looking for any divergence, we had a bullish divergence here. The price bounced, hit our 23-38% target range. And just to demonstrate, again, taking it back to that range there, that's at 23-38%. Broke perfectly into that range, and still in that range actually, and moving sideways according to that 23-38% Fibonacci. But more recently, you can see there the hourly's broken to the downside, and so is the CCI. Now going to the back test, I've marked it here where you would have gone short, but again, because of that bullish divergence, it's avoided entering the trade. You possibly may enter a trade shortly with the price and the CCI breaking below. So all daily and hourly signals are showing short positioning only. That could break down to below that moving average range once that CCI 14 strategy kicks in. Again, that's in a description below for learning how to trade that strategy. So looking at spot gold, now on the weekly first off, you can see that it's been consolidating that way for a number of weeks now. Everyone, or all the news articles you're reading about, are saying bullish move on gold and it's a strong buy. I'm a bit more cautious than that. You'll notice here I've marked here a bearish divergence, a very long-term bearish divergence. It's been happening now for most of 2024 and this year as well. And currently it's consolidating, looking at like possibly breaking below that moving average range. So again, I'd like to see this CCI start breaking higher and invalidating the divergence. But also at that stage, once we see that CCI break higher, we're going to see also the price break into new highs as well. But at the moment, so long as we've got a bearish divergence, I'd be more cautious about going long until we see, as I said, until we see that divergence being invalidated. I've marked here a 23-38% target range, and that'd be drawn on the weekly from that high down to that low. That's that 23-38% range, covering that divergence, which is most of 2024. So you always take it back to the previous low before that divergence started. So at the moment, I'd call it a neutral positioning on the weekly. The daily is also showing us a bit of a roller coaster event here with highs and lows above the price moving averages and also the CCI. You can see there the CCI is still declining. Again, even on the daily, we've got a bearish divergence, and that's also showing bearish movement at the moment, or I'd call it a neutral positioning. Having said that, we still look at the 1 hour time frame. You can see there sudden rise, and currently it's pulling back again. The CCI has already broken into that moving average range and finally breaking. Looks like it's going to break below that moving average range. So if you want to be very cautious, I'd be avoiding buying or going short at the moment for gold. And as I said, until we see a more decisive move away from this consolidation period. But having said that, let's go to the back test to demonstrate a few trades that could have been taken. So back here, we started the short positioning here from more recently, from that point there when the price broke below the moving average, and so did the CCI, just about to break below there. On the that was around about the 11th of August. You would have taken some short trades there, and again closing out your positions once you see that moving average range on the price break higher. So you would have got out somewhere there, and that would have yielded you about $482 going short. And again, waiting for further short positionings. You can see there on the hourly, breaking below the price and the CCI moving average. Taking another little short trade there. At the moment though, notice the price, I haven't drawn an arrow for it, but you can see there the price would have been back to that one there. Broke above the moving average on the price and also the CCI. So you would avoided going short during that period. And that's why I've got the long positions here going back here to that point there on the 4th of August is demonstrating long positions. Again, you would have avoided going long at that point. You might have had a contract open and you would have closed it out with a nice little profit at that point, giving you about $1,700. You would have avoided that drawdown going short until such time you would have then gone long again, possibly here. There's no trade open going long according to this strategy of this program. So at the moment, taking long trades only, but again, wait for that to be more decisive above the moving average range on the CCI. The price is already above. I like to see that break higher to confirm that bullish move. So this is natural gas, and if you're a regular follower of my natural gas videos, you're probably already aware of these charts, but I'll go through it again anyway for those new to the channel. So on the weekly, first off, we've got the price and the CCI well below the moving averages, giving us bearish momentum. And at the moment, if you're trading on the daily, you'd be going short according to that period there. On the daily, we've started going short from back here around about the 23rd or 4th of June, when the CCI and the price broke below the moving averages. You would have closed out your position if you're trading on the hourly at the very latest at that point there, near the bottom of those candles, and then reopen it again going short and again closing it out again. And since then it's been fluctuating above and below the CCI, giving us a potential consolidation, but the price is still below. So if you're trading on the hourly, going short only. Again, looking at the hourly before we go to the back test, we're looking for any divergence. Now, we've had a couple of divergence clustered in here more recently. The first one was back here, higher lows versus that point there. That actually bounced, hit our first target. And since then, the CCI kept rising, the price kept rising, and then finally we had a new higher low there versus a lower low on the price. That actually hasn't actually hit, actually no, it did hit more recently. You can see there it hit that range there, bit delayed. But we've also had a smaller bullish divergence there in that range there, and that also was hit by the same price movement. So those two divergence ranges, that longer one and that short one, were hit with that little bullish move above the moving average there. Now again, you wouldn't have gone long at that point. You would have taken any, closed out any short positions, and I'll show you the back test in a moment. But at the moment, you would have started new short trades from that period when the price broke below the moving average, and so did the CCI. So again, looking at the back test, going short from this period back here and about the 24th of June, as I said, right back there, you would have taken short trades only. You can see there was a bit of a drawdown there, but you would have avoided that. Why? Because you've got bullish move on the CCI and bullish move on the price. Again, we don't take long trades during that period. We avoid going short, so you would have closed out at the very latest. You would have closed out your positions once you see the price start bending up above those moving averages. And again, I have deliberately zoomed out of the chart. Sometimes when you, again, I've said this before, but when you zoom in too close, sometimes you're focusing on the bug on the windscreen. What you want to do is focus on the road ahead of you. So by zooming out, you can see the upward movements and the downward movements of those moving averages. So again, if you're going short during those periods, avoid going long. Go short in accordance with the daily movement. Avoid going long. So you would have closed out your positions on each one of those little upward swings. Don't forget, reference the +1 videos to get a better insight into the trading strategies. Thanks for watching, and see you in our next video.